Hello and welcome to my YouTube channel. I'm Ahmed, a senior lecturer in accounting and finance in a UK university. I also work with ACCA as an early career ambassador. In this video, I will walk you through a question from Consolidated Statement of Financial Position. I recorded a video, a step-by-step approach previously, but in this case, I will show you how you can apply that approach in a given situation. I found that a lot of students, they struggle with consolidation. But if you take a step-by-step approach, then it's pretty straightforward. So the task I have chosen, this is from AAT Practice Assessment 2, and obviously in relation to the consolidation. So I'm just going to share my Excel sheet where I have written this step-by-step approach. And as you can see, the step one is you need to write down or select items from the drop-down menu. So in case of AAT level 4, you will be selecting, remember, the items from the drop-down menu if it is not already provided to you. Sometimes it's provided to you and all you have to do is just do the calculations. And then step 2 is deal with the items that require little or no adjustment. Now, this is important step because without doing much hard work, you can secure some easy marks. So what it is, for example, if you're calculating property, plant, and equipment for the two companies, sometimes simply you are just adding two companies' property, plant, and equipment together. Or if there is a fair value adjustment or revaluation surplus at the date of acquisition, then of course you add it. Similarly, for example, share capital you always write for parent company only, and share premium you will write for parent company only. So those are kind of easy marks that you can score. So once you've done that, then the step 3 is you are going to complete the workings. Now, some of the workings are given to you as part of the task, the way you have to show those workings, because these workings have separate marks. So it's important that you complete those workings. And then last step is that you just complete the consolidated statement of financial position. So I have written down the format here, but remember that in your actual task that you will be either provided this as part of the question, or you might have to select from the drop-down menu the right sort of sequence of the items in a consolidated statement of financial position. Okay, so what I'm going to do now, I'm going to take you to the question now, and we're going to apply this approach. Okay, so this is task 5 from the AAT Practice Assessment 2 from the drafting and interpreting financial statements. Now remember that the information is provided to you as part of the reference, and you've been provided a format. So which means that you don't have to select these items because it's already provided to you. So all you have to do is you need to do the calculations and then complete the statement. Okay, so as you can see that the information is provided here in the reference material, and you've been provided obviously a parent company statement of financial position and the subsidiary company statement of financial position. And then you've been provided some further information. We'll be using that information in order to complete our consolidated statement of financial position. So percentage of ownership is provided to us, which is 80% of the issued share capital and voting rights. And they also provided that what is the share capital and return earning at that date, okay, of the subsidiary. Okay, so remember that the step 1 was selecting from the drop-down menu, which we don't have to do that in this case. The second step is deal with the items that require little or no adjustment. So if you think about it, goodwill we will have to calculate it as part of working, which will be over step 3. Property, plant, and equipment. Now we need to look at that if there is any fair value adjustment, if there is any revaluation surplus, in other words. So let's look at the information. Now you can clearly see that there is no fair value adjustment. So what does that mean? That simply property, plant, and equipment, you will be adding two companies' property, plant, and equipment together. So as you can see, 4239 plus 1728. Excuse me. So when you add that together, that gives you the value for property, plant, and equipment, 5967. Okay, we will deal with goodwill as part of our one of the workings. But remember, share capital is always parent company only. So the share capital of parent company is 5. Retained earning, we will have to do another working for that as well. And non-controlling interest, normally we'll have to calculate that in working. As you can see, they ask you to calculate goodwill as part of this working, and similarly for retained earning as well. So what does that mean? That you must have to show that. So then if you make an error or something like that, so at least they can give you the credit which is due. Okay, now what I'm going to do, I'm going to show you that how many workings you are going to complete, a step-by-step approach. So which is, for example, the first working should be the group structure, although that there are no separate marks for that, but actually it will help you to complete this question. Similarly, working two is going to be net assets of subsidiary, which in this case, the net assets of Pearl Limited. Okay, so I'm just going to take you back to my Excel sheet where I will be showing you all of these workings. So in group structure, we know that parent company is Bold Limited, or is it PLC? Well, PLC. So Bold PLC. And then subsidiary is Pearl Limited. Okay. Now, percentage of ownership is given to us already, which is 80%. However, in some questions that the percentage of ownership might not be provided to you. So in that case, you will have to calculate it. But in this case, it's already provided to you. So how are you going to calculate it? It will be share capital acquired divided by total share capital of subsidiary. Okay. So that will give you the percentage of ownership. But in this question, we don't have to do that as it is already provided. Then we can work out that what is the non-controlling interest. So if percentage of ownership is 80%, that means the non-controlling interest, in other words, that the interest of other people, third party, not the parent company, other than parent company. So this interest belongs to third party. It could be one, or it could be shared between multiple shareholders. Okay, so that's non-controlling interest. So although, like I said, that there are no separate marks for this because you are not going to record it anywhere in the answer. Having said that, it does help you to complete the rest of the workings. It does help you to complete the question. Okay, now the next working is quite important because you will be using this information in order to calculate goodwill as well as non-controlling interest. Okay, so net assets of subsidiary at acquisition, say the date, so the date of acquisition, and at reporting date. Reporting date is the year end date, of course. So share capital. And as far as this question is concerned, there is no share premium. Otherwise, we would have had share premium. So I'm writing it here so you remember that if there was any share premium of subsidiary, we would have written it here. Again, there is no revaluation surplus or fair value adjustment at the date of acquisition from the information given to us. But I'm going to write it here in case that in another question that you might have to deal with that. And then return earnings. This one you got to be very careful because remember that at the date of acquisition, the whatever is the accumulated profits of subsidiary or retained profits of subsidiary from the date of acquisition until the reporting date, the company must have made some more profits. So therefore, that you will have two amounts, two figures. So one at the date of acquisition and the other one is at the reporting date. Okay. So share capital is provided to us in the question. And if you look at the share capital, there is 1,000, in other words, 1 million. Remember, 3 zeros at the top. And then the share capital in further information is the same. So which means that that has not changed. So that's going to be same at acquisition date as well as at reporting date. Share premium, we know that there is nothing there. Revaluation surplus, we know that there is nothing there as far as this question is concerned. Now, retained earning, like I said, you got to be careful because this retained earning at acquisition date is normally provided to you in the further information. And then at the reporting date is from the statement of financial position of subsidiary. So the retained earning which is provided at the date of acquisition is 640,000. So remember 3 zeros at the top. So that's going to be 640 here. And then at the reporting date, which is remember as part of this single company statement of financial position of subsidiary, which is per limited in this case. Okay, so that's 690. Now, this will be the net assets at the date of acquisition and net assets at the reporting date. So in other words, this is this. Okay. Now, this you will make use of in calculation of goodwill in your working 3. And at the reporting date, this will be as part of working 5, which is your NCI, calculation of non-controlling interest. Okay, so calculation of goodwill. Here you will have cost of investment. Okay, and this will be NCI, non-controlling interest at acquisition. Now try to understand this. Remember, parent company only owned 80% of the shares of subsidiary, which means that 20% belongs to someone else. Now, if you think about the whatever they paid, that's 80% of the value of the company that they paid for. So which means that if we want to make it 100%, then obviously that 20% value of those NCI, non-controlling interest at acquisition, which is 20%. So then that makes it 100% because we're going to deduct the entire net assets. Okay. So there are two ways of calculation of goodwill, but this is the way which is recommended by AAT. So that's why I'm using only this one here. Okay. So in other words, that this is 80% they paid for, and this is the value of the remaining 20% from the worth of the net assets, in other words. Now, the cost of investment, where you're going to find it, you are going to find it as part of the statement of financial position of parent company. So I'm just going to take you back to the question so I can show you all of that information. And also what I will suggest at this point, if you can take a picture of this information, so I don't have to go back and forward. So it's going to be easier for me to just kind of, deal with those calculations. Another way of making use of this video is that if you open this question from your end and then you are listening to this video, it should help you. Okay. So hopefully you have taken one picture until this point and then another picture, this one, so which you will have all the information you need. Okay. So as you can see that the cost of investment is this amount here. So investment in Pearl Limited, which is this is how much they paid for. I'm going to take you back again to Excel sheet. Okay, so the cost of investment is provided to us. We just have seen it. Now this net NCI at acquisition, this will be, remember that we said that this net assets at acquisition of subsidiary, we will be making use of in our working three. So whatever the net assets are, which is 1640, times by NCI percentage. So remember in this case, the NCI percentage is 20%. Okay, so which is 1640 times by 20%. So that is 328. And what we do next is that we deduct net assets acquired. You remember this is the 100% of the value, which is 1640. So minus 1640. Now after this, if there is any impairment, goodwill impairment, then of course we deduct it. But let's have a look into the question that if there is any impairment of goodwill. Well, they've given us information. The directors have determined that goodwill was not impaired at 31st of December 2021. So which means that there is no impairment. So we don't have to worry about impairment. So this will be the final sort of goodwill that will go in your consolidated statement of financial position. And that is 188. So I will show you how you're going to write all of this as part of that working provided to us. But I just thought, here that I can explain it a little bit better. Okay, so that's our working three. And let's calculate now working four, which is group retained earning or retained earning. So first of all, you're going to write the retained earning of parent company, which is Bold PLC. And that is provided to you as part of the question. So as you can see, the retained earning, and this has to be at the year end, so which is given to us in the single company statement of financial position of parent company, and that is given to us as 820. And per limited, now remember, this will be post-acquisition retained earning, post-acquisition profits. So in other words, how we can calculate it is total retained earning at the year end minus retained earning at acquisition. So that gives you basically post-acquisition retained earning, and then times by percentage of ownership, which is 80%. So in other words, the total retained earning of subsidiary at the year end is given to us as 690. And retained earning at the date of acquisition is 640 times by 80%. So in other words, 690 minus 640. So that gives you basically 50 and is 80% of 50, in other words. And that is 40 basically. Okay. Now, although that in this question that you don't have to deal with that because that information is not provided to us, but remember that unrealized profit, if there was any purchase and sale transaction during the year, intercompany transaction, remember in relation to that, there might have been some unrealized profit. So we have to remove from these profits if it was provided to us. But in this question, you don't have it, but you can have it in another question. Similarly, what we do is that we deduct any goodwill impairment. So again, In this question, it's not provided, so we don't have to worry about that. But in case in another question, if it will be provided, then of course you will have to calculate it. Okay, which means that our retained earning or group retained earning is this. There we go. Then NCI. Now remember what I said when I was going through the working two, that net assets at reporting date, we will be making use of it when we will calculate non-controlling interest. So this is calculated as net assets at reporting date times by NCI percentage. So net assets at reporting date, remember it was 1690, this amount. So 1690, of course, 3 zeros at the top, so that's why I'm not including that. So times by 20%. And that is 1690 times by 20%, which is 338. So we completed the workings. Remember, the working was the third step, if I remind you. And the fourth step is just complete the consolidated statement of financial position. Okay. So let me take you back to the question so we can complete it. Now, remember goodwill we have calculated in our working three, and that was 188. Okay, and now current assets here, you can see that they did not really give you separately our breakdown of current assets. They just given you a collective amount. So what we need to do, excuse me, we need to add two companies' current assets together. And if there is any adjustment that we will be making. So if you see that if there is any intercompany receivables, something like that, then we need to remove it from there. So as you can see in the second bullet point, included in the current assets of Gold PLC and in the current liabilities of Pearl Limited is an intercompany balance of 38,000. Now remember, we use the single entity concept, which means that when we are preparing these consolidated financial statements, we are treating the whole group as one entity. So in a group, remember, is parent and subsidiaries normally. So we are not considering them separate entities. So we are considering them as one company, the whole group. So as such, it's almost like I owe something to myself, you know. So therefore, we need to remove the effect of intercompany transaction. So in current asset, simply what it will be, current assets of parent company, which is given to us, 831, plus subsidiary, which is 142. And then what we're going to do, we're going to deduct the intercompany current assets, which is, as you can see, is 38. So remember 3 zeros at the top. So this 38, we will be removing it from the current assets. So that gives you 935. Okay, so one side of your consolidated statement of financial position is completed now. So let's take care of the other side of the consolidated statement of financial position now. Retained earning, remember in working four, we have calculated it. And that is 860. Again, non-controlling interest, we have calculated it as part of the working five. So that was 338. Okay, and then non-current liabilities, let's have a look. You can see the long-term loans. So simply we will be just adding two companies' long-term loans. And that is 418 plus 124. So that gives you 542. Now current liabilities, You got to be careful here because, again, remember that there is an intercompany liabilities, current liabilities, or intercompany trade payables, in other words. So we must have to remove the effect of that. Again, that's between the group. So remember that we are treating the whole group as one entity. So therefore, we need to remove the effect of that. So the total current liabilities, which is 332 plus 56, that gives you 388. And what we're going to do, we're going to deduct that 38 as in intercompany transactions. That gives you 350. And you can see that our total assets are equal to total equity and liabilities, so which is a verification point for you that your answer is 100% correct. Now, let's suppose that in exam that it doesn't balance. Should you panic? The answer is no. Unless that if you know that you made multiple errors, is different. But if you made one single error and you might be losing a couple of marks, so you should not panic in that sense. Okay. But yeah, of course, if you make multiple errors, then it can be concerning. Also, ideally, you should not be making any errors if you're very well prepared. But it can happen in the exam, and the worst thing you can do to yourself is panic. Okay, I know it's easy for me to say that, but if you kind of practice that, and if you are aware that, well, you're gonna only lose a couple of marks, then of course you can move on to the next question, and it's easier because once you panic, what happens that psychologically you are putting yourself at disadvantage, and it could be problematic for you. Okay, all the best. Thank you.